Forex Jargons 101. Cutting through the noise. When you're new to Forex trading, you might hear words that don't seem to make sense. For example, when traders talk about bulls, bears, hawks, and doves, are they really obsessing with animals? What about longs, shorts, highs and lows? Does distance matter in trading? To help you understand what traders are really talking about, let's go through some of the most common jargon. When a trader says they are bullish or bearish, it simply means they're expecting the market to rise or fall. Similarly, if they say they are long or short, it means they have bought or sold a currency pair. When a trader has made money, you might hear them say, "I made 100 pips on this trade." But what's a pip? In Forex, pip stands for percentage in point, and it's simply a unit used to measure very small movements in currency pairs. For example, if the value of a currency changes from 1.0000 to 1.0001, the price has risen by 1 pip. So, for our traders who made 100 pips on their trade, the price would have moved from 1.0000 to 1.0100. As a general rule, pips refer to the fourth decimal point. But watch out when trading the Japanese yen, where pips represent the second decimal. 3 other words you'll often hear in FX trading are bid, ask, and spread. Bid is the price at which you sell a currency pair, and ask is the price at which you buy. The spread is simply the difference between the bid price and the ask price. Traders typically hate high spreads because it means they pay more for each trade. And that's why it's so important to pick a broker with low spreads. Wink. Another important thing traders talk about is leverage and margin. 2 concepts that go hand in hand. Leverage is a way to multiply your buying power. For example, if you had $100 in your account and applied 1 to 100 leverage, that gives you buying power of $10,000. In other words, that's $10,000 of free margin you can use to trade with. You'll find that some trading products, like Forex, require less margin, while others, like commodities, require more. The next thing to do is decide on your take profit and stop loss levels. A take profit target is a level you expect the price to reach in favor of the direction of your trade. For example, if the EUR/USD was at 1.2 and you expect it to rise, you could place your take profit target at 1.3. When the price reached that level, the trade would close and you would bank the profit. A stop-loss target is a level at which you would get out of a trade, usually, as the name suggests, at a loss. Using our EUR/USD example, you might still hope the price to rise to 1.3, but to protect your account, you also set up a stop-loss at 1.1. If the price decreases to that level, the trade would automatically close, preventing further losses. This makes a stop-loss a very useful risk management tool. If you don't set up a stop-loss, you risk receiving a call you never want to get, the margin call. This is a hypothetical bad news call to let you know you've run out of margin and you need to add funds to your account. If you still don't top up, and your trade continues to lose, you stand the risk of getting margin closeout. This is when the broker closes your position to protect you from losing more than you have deposited. So make sure you don't forget to set up a stop loss.